Guess what, folks? Inflation and rising interest rates have resulted in a rise in financial market volatility this year. But even while the markets are challenging, guess what? There are some opportunities out there. And here to talk about these strategies is Jim Lineweaver. And boy, you know, we're always talking about like working that market. It's up a little, it's down a little, it's up a little, it's down a little. Now it's down. The lowest since 2009. So what are people doing and thinking?
Yeah, well, actually, it's we're technically in a bear market this year, right? Because a bear market is when the indices fall 20% or greater, which you see kind of across the board. But also, you even have the fixed income market that's down over 16% year to date. So it's been a volatile market, to say the least. So if people want to really look at some things that they can do to their portfolio,
new strategies.
Some strategies, yes. So you can look at income-producing things, but there's also ways to hedge the portfolio too.
So what kind of strategy should they use? I mean, like I know a lot of people are looking at it and they're thinking buy, sell, and all get all involved in it. But you have to have a real plan, don't you?
You do. I mean, if you're looking at the income side, which can really kind of buffer the highs and lows of a portfolio, because don't forget, 40% of the return of the S&P 500 is actually coming from dividends and things. So you can look at dividend-producing stocks, but also interest rates have come up. So hey, you can look at your banks for CDs. You can ladder them out. You can actually look at 1- and 2-year corporate bonds right now that are paying around 4 to 5%. And if you hold those to maturity, and then what ends up happening is you don't have to deal with this interest rate risk like with the Fed raising rates next week. But you also can look at real estate because it can be a great hedge over time. Now, granted, the housing market is starting to dip, right? People are pulling back. But there's other industries that are part of the housing sector where professionals and people that own maybe apartment buildings and things will be able to pass on the rent. And you could take advantage of that because that can be a good inflation hedge too.
Yeah, so everything goes back to that raising the rate right now. So, I mean, people are going like, well, if they're going to raise the rate next week, maybe I should do something right now. What should they be doing?
Yeah, well, timing the market doesn't actually work,
yeah, that's
right?
What everything's like, now's the time to get out.
Right, yeah, and usually when everybody wants to get out, that's actually the time to buy because people get their emotions involved in their portfolio. But actually, if you look at a study that became between 1990 and 2017, what they did is they looked at the overall market, and if you missed 5 of the best days, it ruined your return or took about 40% of the return out of your portfolio. So when timing the market doesn't work. As a matter of fact, asset allocation is so much more important because that'll make up about 92% of your returns, whereas trying to time the market will only make up less than 2%. So like for us, like what we did is we got into energy in the beginning of January 2021 because we kind of saw what was coming and what was going to be taking place in a sector that was pretty beaten down for the last 5-10 years prior to that. And now it happens to be the #1 performing sector this year. As a matter of fact, it's the only sector that's up this year to date.
You know, that's an important lesson right there. You know, we have a lot of people come on and they're selling stuff. But, you know, here we're getting a lesson, we're learning something. You know, you're talking about fuel, gasoline, oil, that sort of thing. Yeah. I remember a few years ago, you know, you couldn't give this stuff away. And people, they had it, and they had it, went down a few bucks, so they sold it just to, you know, I'm not going to lose any more. Yeah. But if they would have just sat on it like an egg, now it'd be their biggest winner.
Yeah, and that's why, you know, when you look at things, but they changed the dynamics, right? So you have to pay attention to that and try to be a little proactive because what a lot of these oil companies are doing now is they'll have their standard dividend, but if oil stays above $40 or $50 a barrel, they're going to pass through a special dividend. Some of those dividends get these up to 8 to 9%, which can really be helpful.
So, and when you're trying to time the market, I mean, there's only so much in your portfolio that you can actually move around and do something with, right?
We got to be careful about that, but that's why there's other hedges that you can do. So in other words, there's something called a buffered ETF out there that actually buys an option on the market. So it's going to cap your upside potential, maybe in the 15 to 20% range, but it'll protect the first 15% of the downside. Yeah. So let's say, and it's liquid, but they measure them on a 1-year basis. So in a year, if the market's down 15% or less, you're made whole. If the market's down 20, you'll be down 5, but guess what? They're going to buy back in with your money down at that 20% level based on the S&P 500 for the next year. And they tie these to a lot of different indices, too.
Okay, I only have a couple seconds left, but I want to ask you, so say someone's sitting out there right now and they're not really happy where they are or maybe how it's being handled, but you're saying, like, don't move with timing and all that kind of stuff. How can you help that person?
Well, see a professional, right? And I would say get a second opinion and see a certified financial planner. Okay?
Like you?
Yes, exactly. Or there's other ones out there, too, right?
Yeah,
but they took the time to get their credentials, and they're professionals in the industry. Yeah. Right? So I would really encourage people to do that, and it's a great time to get a second opinion.
It makes a whole lot of sense. So it sounds like it's one of those times it pays to be proactive rather than reactive. So if you want to see how you can use these strategies, call Jim and his whole team. They're here to help. And don't miss the Financial Quarterback when? Leading into Fox News on Sunday. That's when. And thank you very much, Jim.
Always great to see you.
Always great to see you, too.